on rate cuts.
It wasn't recorded, so it doesn't count as wrong.
Didn't we record that? We recorded it. We went public with both saying no cuts this year.
Oh, yeah. I'll fall on that. I published, printed, and said it multiple times. No cuts.
Hurts to be wrong. Well, welcome everyone to episode 58 of Top of Mind with Consilio Wealth. Today is Friday, September 20th, 9:46 in the morning Pacific time. It is a beautiful day today, like always. And our first topic of the day today is the Fed cut of 0.5%.
And what are the impacts of those cuts, right?
Yep. We'll touch that for number 2. And number 3, Microsoft just inked a deal today with Constellation Energy. They're going to be buying energy from them. And the stock popped on the news. Well, let's get rolling. Okay, Fed cut. This is painful for us, everybody, because coming into the year, the market was pricing 6 rate cuts. And for reference, a rate cut is a 0.25%. One cut is 0.25%. So the market said that's going to happen 6 times this year. And Howe and I got in a room earlier in the year and we said, not a chance. There's no way. There's no way. Because consumer spending was so great. Economic strength was good. Job market was good. Everything was so strong. And we're like, there's just no way. Well, things have changed a little bit. Consumer spending has slowed a little bit. Unemployment has ticked up a little bit. Inflation's kept low, though. And the Fed came out on Wednesday of this week and delivered a double cut of 0.5%, 50 basis points. How? What do you make of this, other than us being totally wrong?
Yeah, and I think it's probably overdue based on the trends that we saw since last July of 2023. So we saw inflation bottom or steady at that date. And I totally get that the Fed's like one data point. We're not going to cut rates just because 1 month. But it was August, September, October, November, and all the way through till this September. Then they finally, after 14 months of data of inflation remaining flat, they're finally acting. Mm-hmm. So yeah, if you read the article, I said I wish I was wrong because we needed financial conditions to loosen a little bit, right? Imagine buying a house 3 months ago, and how much easier it should be buying a house in 3 months from now.
No kidding.
So I think the Fed they kept hiding behind the data, right? And everyone kept telling the Fed that the data is stale. Like, what are we doing here? So I think the biggest difference is the Fed is trying to get ahead of the data, knowing that they actually have instant or simultaneous data, where in the past they've been quoting a month-old data or even, in some cases, 2-month-old data to make their decisions. And everyone was saying, do car loans need to be at 10% interest rate to slow down inflation? And I think the resounding answer was no back in March. And yes, we were gloating in April, May that we were right this whole time. But the Fed was not reacting to the data as it happened. Rather, they were relying on old data.
So you're now saying they should have cut sooner?
I'm saying they should have cut sooner, yeah, despite our prediction.
Okay.
I think after 9 months of solid data, even then might have been too late. So we're looking July 2023, and 9 months after that, I can't do math right now. It's April.
Can't do math on the air. That's for sure.
Yeah. It's April 2024. They should have cut, and they cut twice now. So that raises a lot of questions, right? Why this jumbo-sized cut? We haven't had a cut this large without a recession. The only time we cut twice as its opening salvo was in 2000, 2001, and then again in 2009. What preceded those events, right? Like that, those were warranted. This one seems more like, hands up, we screwed up. We should have cut earlier in the year. Now we're making up for it by doing 2 cuts in September to make up for that lost time.
Interesting. So But they were looking at other things. So inflation
Yeah.
came down. That wasn't their only metric. So
No.
I think that they were also concerned with the job market remaining so strong and just frankly the economy remaining so strong. So what do you make of their decision to cut, now, because it would appear that data has started to deteriorate? No?
Yeah, I think the jobs unemployment number is a little bit trickier to stamp. Like, we've got to create jobs. We've got to slow down jobs. It's not an instant thing where companies are hiring and firing people because of a 50 basis point cut or not. You know what I mean? I can't see companies who were resistant to putting a job posting out suddenly do it today because Wednesday interest rates are lower by 0.5%. So jobs is a little bit trickier because it's not so reactive to rates, believe it or not. So what they saw in the data was, yes, the number of job openings slowed, but I think that number might have been inflated in 22, 23. You remember the term phantom jobs, where employers would put out multiple jobs of the same position. They're only looking to hire one, but they put 4 postings out in different regions hoping to get one bite. That's how crazy the job market was employers were having to put specific jobs in different regions for that same job. In, let's say, New York, they would have a posting in the Southeast, the West Coast, and the Pacific Northwest. So that was one job, 3 postings or 4 postings, and that inflated the jobs opening number back in 22, 23. Now that the number's coming down, the Fed, this over data reliant Fed, is saying the number of job opening is slowing. And they're concerned about that because you got unemployment at 4.2, it ticked up to 4.3. That particular percentage is concern of theirs because their dual mandate is inflation, 1, and 2, like 1A, is unemployment, full employment. Their target is 5%, right? They've gotten inflation handled, and we're saying they've handled it for the last 14 months, right? It's been handled. Why the delay? Well, the thing that's triggered this is the number of potential job openings are shrinking, because that's a leading indicator for potential job losses, right? No one's been laid off outside of tech yet. And I think that's what the Fed is really trying to stem before it happens, because once we start losing jobs, that it snowballs, right? We could easily overshoot 5%.
Unemployment's been ticking up since like June, July of 23.
Yeah.
So it's been slowly going up. But as you pointed out,
3.8 though. Now it's 4.2. So it is ticking up, but very much a slow trickle.
Good call out, right?
Yeah.
Slow trickle. And as you pointed out, it's also the return of people to the workforce. So unemployment goes up when you have more people looking for jobs. So, we commented on this on one of our prior episodes. When we got a bad unemployment report, it was because more job seekers entered the workforce or entered the hopeful workforce.
Yeah.
And so that created more unemployed people. So possibly that's happening now as well. That also could be a sign of consumers running out of money. I got to go back to work, that kind of thing, or change jobs, that sort of thing. Don't know. There's a lot of these things that we don't know until we're through it and looking in the rearview mirror. But I think it's interesting that the Fed cut. Coming into this, I was pretty certain that the Fed was going to cut. But there were a lot of people that said, and the market was even pricing this in, very high likelihood of 2 cuts. So the 0.5% cut. I was like, no way. There's not a chance, because if they cut by 0.5%, that to me signals that they think that they're behind the curve, and they have done nothing but exude confidence in this entire regime. And if they do that, I thought it would actually spook markets into they see something that we don't. Oh my God, we're going to sell off. That didn't happen.
It kind of did initially, but then Thursday was a big rally.
Yeah, good point. Yeah, well, it it rallied right after the news of the rate cut, right? And then Jay Powell starts talking as usual, and the market sold off, right?
Yeah.
Isn't that what happened?
Yeah.
And then Thursday, yeah, everything jumped pretty strong.
Yeah, the Nasdaq was up 3% in response, right? So I think the market does have these knee-jerk reactions, and then all of a sudden, the information gets more absorbed. I don't know what's really happening with some of the algorithms to make them say, well, Wednesday was bad, Thursday good. Nothing changed overnight. So, but that's the market for you.
You also have in here, so the market's price, or rather the Fed, in their statement, they said we will remain data dependent, but we will very likely cut 2 more times this year. So they are expecting 2 more 0.25% cuts this year. So, half on Wednesday, 2 more quarters. So that's 1 full percent this year, plus 4 more rate cuts in 2025. That's 1 more full percent. So bringing rates down by 2 full percent between now and the end of 2025. But what's the market pricing in?
Yeah, so when we say what the market's pricing in, Chris and I actually look at the trades, right? So we're not saying on assumption, right? So the futures market does trade interest rates for November 7th, December 18th, which are the next 2 Fed dates. The market is pricing in 3 cuts for the remainder of the year. So the market is a little bit more aggressive than the Fed, and it has been more aggressive than the Fed consistently because the market is a little bit smarter than the Fed, right? So these are trades that where traders are putting actual money at risk versus the Fed, all they have is their reputation at risk. So I would generally stick to where people are putting their money where their mouth is, right? This is a prediction market that up to the Fed meeting was pricing in 60% odds of a double cut, when everyone's saying, even us, we're saying that just shoots their credibility. They're not going to do 2. And the futures market was right. So they're saying in November now, 48% chance of 2 cuts, 51% chance of 1 cut. And December is 50% chance of 1 additional cut, and then 25% chance of, it looks like 3 cuts, which is pretty odd. So they're getting pretty aggressive in terms of expected cuts.
Well, I'm going to stay in my camp, and I'm going to say not a chance. I think the Fed cuts by 0.25% and 0.25%. So I think they bring rates down by another 0.5% between now and the end of the year. I think what they said they're going to do, unless data materially deteriorates. But I think that, especially with this big cut that they just delivered, I think the last thing that they want to do is start to go down fast.
Yeah.
I think they're going to go down slow and very, very purposefully.
I think the caveat's important, right? We have 2 more jobs reports before the next 2 meetings, and those are going to be important, right? But a 0.5 point cut now isn't going to stem the September jobs report and the subsequent October report. Those hiring decisions, those firing decisions have already been made. Interest rates aren't going to affect it for another 18 months at least.
Which, remember, they said a lot, right? As they kept hiking rates, and everybody was like, what are you guys doing? Inflation's coming down, things are looking better, and they kept hiking rates. And they kept saying, well, we recognize that it takes a long time, 18 months, for our work here to really reverberate through the system. And so they're going to continue to say that on the way down. I think that if 1 bad report comes out or 2 bad reports,
it's a 2,
they don't react immediately because it just takes so long for their changes to really do anything.
Yeah. But again, they're here because they didn't want a repeat of the 70s, right? They don't want to be known as the Arthur Burns Fed. Again, reputation aside, I think there were things that they could have nibbled at and improved financial conditions without having to go to these extreme lengths because they waited so damn long.
Okay, so I'm in the camp of 2 more 0.25 point cuts between now and the end of the year. What's your camp?
I agree. I think the market tends, in the very short term, again, they were right this last round, but they tend to be over optimistic in terms of the amount of cuts.
Yeah. Let's shift into the domino effects of these cuts. So mortgage rates kind of priced this in, but they dropped a little bit more after this cut. Let's talk about mortgages. I really want to know what you think the real estate market's going to do. There's kind of two camps of what prices do, and I read something that Zillow has a prediction this morning. So, yeah, what do you think?
Yeah, our theme for this whole section is going to be the market's already priced in. The market already beat the Fed to this.
Yeah.
Right? So the mortgage rates peaked at, let's say, 7.5%, and it was sitting on average at 6.29% in February, and it dropped to, I'm going to ballpark here, at 5.5% starting in late July.
Mm-hmm.
So nearly a full 2 months before the Fed cut. So the market is already anticipating the cuts. And again, mortgages are more supply-demand driven, but it is somewhat pegged to the 10-year U.S. Treasury, right? So the Treasury is at 3.5%. It makes sense for the mortgage rates to be around the 5.5%. Historically, at a 3.5% U.S. Treasury, mortgage rates should be 4.5% to 5%.
Right.
Banks are baking in an extra 1% because on the front end, which the Fed controls, they're having to pay their deposits 5%.
Mm-hmm. So, and I think that's something that we should highlight here. So a lot of our clients and a lot of people out there have been moving money into high yield accounts and money market accounts.
That's the other domino. Yep.
Yep. And that is going to go down very quickly. In fact, I am surprised I haven't gotten an email yet from Marcus. Hi, your rate is going down. Because they usually go down faster than they go up, as all these do. So just know that if you're in a money market or if you're in a high yield savings account, that will go down very soon, probably in lockstep with 0.5%, possibly a little bit more, depending on what's priced in. Some of these accounts already started going down even before that first rate cut, again, because the market was pricing in these cuts, and what's priced in is what's getting paid. And so, a bank can't pay you, a below or an above market rate. So just making that message clear that your rates on your high yield accounts will start going down.
Yeah. And I think what the question is, what do we do now? Unfortunately, I think the market already answered that for you 3 months ago. Chris and I have been saying lock in, whether through CDs, through treasuries, something that's longer than 7 days, which is the money market. So I did check. It's still paying, the Fidelity version of the money market fund is paying 5%. That's going to reset on Monday, right? A lot of the holdings in that is 7-day maturities. Guess what matures on Friday or Saturday? It's a lot of these old 5% bonds.
Yeah, good point. Good point. Those instruments are invested in 7-day bonds. That means every week they expire. That means this week they're going to get invested lower than last week. So your rate will reset here very soon. Yeah.
And then in terms of positioning, again, this might be renamed the History Channel because we're just going to have to talk about what already occurred. And a lot of the movements have already occurred in the past 3 months. So, Chris, I know it might be cheating. It's on page, what? Come on, give me the page number here. I think 4 of the doc, where the grid is. What do you think has beaten the S&Ps over the last 3 months?
Real estate.
That's one, yeah. Real estate. S&P was up 5% over the last 3 months, or quarter to date. Let me name everything that has beaten it. Real estate. Utilities up 14.5%. Dividend-paying stocks up. I know this is really compelling. 8.5%. Real estate up 16.3%. Industrials up 10%. Financials up 11%. Materials up 7.4%. Staples up 8.2%. What do you think all those have in common?
Interest rates. They all
sensitive.
They're all interest rate sensitive. They all use debt to finance their businesses. Just take real estate. That's the most obvious example. If you're driving by an office tower or a shopping center, it's generally not owned in cash. It's generally owned in a part of it is debt. Yeah. Often those debts are variable. And so this is sort of translating this into some good news. I feel like we focused on, oh my God, bad news, your savings account rates are going down. The good news is variable credit lines are going down as well. So if you have a margin loan or a securities loan on your stocks, if you have a variable interest rate credit card, for example, as they all are, or a home equity line of credit, those will all start to move downward with this rate cut as well.
Yep. And utilities, what's causing that? 14.5% for utilities. Like one of the most boring stocks or group of stocks I could think of.
I would assume that the revenue generated by utility stocks is fairly consistent over time. Small increases, kind of inflationary increases. But I would also assume that they use debt to build out systems, build out light poles, build out power generation. And again, the cost of that debt has come down.
That's exactly one part of it. That's actually really true. So as the cost of debt becomes less expensive, utilities boost. But as interest rates come down from safer haven assets, those fixed income investors have traditionally moved to utilities because they view that as the most relatively stable investments that pay a dividend.
Interesting. So yeah, a number of signs of life here. So okay, predictions. What do you think the real estate market's going to do? Do you think that prices are going to go up? Do you think that prices are going to go down? Do you think that prices are going to stay the same?
I think they do go up. I don't think interest rates cut now will really improve inventory. Mm-hmm. It might jostle some of the existing inventory loose, but we need new inventory. We don't really need, or we've had existing homes still go up for sale. Yes, at much smaller numbers, but we weren't building enough units, enough spec homes, enough track homes in general, right? Mm-hmm. I don't know if that interest rates are going to solve that, unfortunately.
I think that interest rates have to go down more to, as you say, jostle people out of their current homes. I think this is maybe a sign of that starting to happen. And as we keep saying, the market will start to price in, mortgages will start to price in kind of ahead of the Fed here a little bit. Not all the way till December of 2025, by the way. That's not going to price in, another 1.5% of cuts. But it will start to price this in. There's two theories here. As rates fall, real estate prices go up because the cost of borrowing goes down. Therefore, it's more affordable to buy that same, $1 million house. And so therefore, there's more people chasing that $1 million house and the prices go up. That's theory number one. Theory number two is as interest rates go down, inventory goes up. It starts to jostle people out of their homes. So they start listing more homes. And with the added inventory, there's more houses to pick from.
Yeah.
That improves the supply and demand balance, which actually has prices come down a bit.
Yeah, I'm going to go 2A there because the pent-up demand on that side. Because, yes, people should be listing more of their homes, their starter homes, their family homes. They're looking to downgrade. Whatever the case is, I think the amount of people who haven't been able to buy homes in the last so odd years, there's going to be a line. At least that's what I'm thinking. Mm-hmm. Unless they spent it on extravagant trips because they threw up their hands and gave up. And that's why it's important to have this long-term plan. If you can get in a house in 2023, do you completely give up on that dream? Some people have, but I think there's a lot more pent-up demand than what like the Wall Street Journal suggests, right? Because they did a lot of exposés where people took out their home savings and went to Disneyland.
Yeah. Well, and I think people, they might say, I've given up on that dream. But then if rates really do go low enough and we get back to that market where your mortgage payment is very similar to your rent, it's just the impediment is the down payment. I think you start seeing a lot of those people switch to buying again. But we're going to need a lot of inventory hit the market to stabilize prices. I think if rates stay kind of moderately high, I think it doesn't push people out of their houses that are stuck at high 2s, low 3s. Yeah. And but it gets low enough to where new entrants are getting affordable rates again and affordable monthlies again. And I think that actually fuels prices to go higher just because of less supply. This will be interesting to watch. I think this is going to be the next 12 to 24 months in real estate is going to be interesting.
I think 5% is like the psychological like watermark, right?
That's what I keep saying too.
Yeah.
Yeah.
And people would feel, okay, 5%, I could trade in 3% and feel okay about it.
4.75, 4.99. Okay.
Oh my gosh. Yeah. If it starts with a 4, I think for me, all bets are off because you should see listings. Again, the big caveat is we've been wrong on housing and the response to higher rates back in 2021.
Yeah.
And I think supply demand is going to trump everything. So if there's no supply, I think that the amount of demand is still going to level. Like it's not going to go down.
I think it was a Zillow article that I read this morning. Zillow is predicting 4.5% real estate appreciation across the country next year. We'll see. Now, national is not local, right? So everybody listening in the greater Seattle area, they sneeze when I say 4.5%. Like, my house does.
That's a steal.
10 to 20 a year, whatever. And, people in other parts of the country are like 4.5%. That's really good. So, recognize that, the I was going to say bubble. Bubble's just not a good word to say on a financial podcast, but, recognize the area that you live in and possibly, past performance does not guarantee future performance. But anyway, we'll tune back in on real estate here in a couple months. We'll keep watching it. I think it'd be very interesting to see the listings data. Interesting to see, to your point, as rates do fall, do more buyers come in? I think there's a lot to unpack there over time. But, and also thinking about everybody that took a 2-1 rate buy down. Like there was a lot of big communities, Toll Brothers communities, D.R. Horton communities that had these selling incentives. And the trick is you advertise the payment. $3,000 a month, you can get in the house.
Yeah, and just fold it into the principal.
You fold it in, the seller has to put it in. So a 2-run rate buy down for everybody that doesn't know. The seller has to pay for this. You can't as the buyer. And let's say that the stated rate is 6.5%. They can buy your rate down to, let's say, 4.5%, hypothetically. So it'll be 4.5% for the first year. Then it goes up to, say, 5.5% for the second year. And then for the remaining 28 years of the loan, it goes to that base rate of 6.5%. Your payment adjusts as well. So the key is it's getting you in at a lower payment because everybody looks at the payment, not the rate. Can I afford the payment? They don't care what the rate is. And so that's kind of the marketing strategy with a lot of sellers in this last market. But the key too is if I'm locking in at 4.5, I'm buying myself 12 months. If I think that rates are going to come down, even if it ticks up 1%, again, if rates come down, I can then refi. So we had a couple clients buy in this fashion, and be interesting to watch those as well over the next 12 to 24 months. If they can actually refi and get out of those loans, my guess is absolutely. I think that's probably a pretty good deal that they locked in because they bought a house. Maybe if prices do go up, maybe at a lower rate, and they got a deal on their interest rate for that 1 to 2 year period.
Yeah,
which is valuable.
All the equity that's been built up, though, I could see people do continue to stay in place too, which is kind of the other unintended consequence because they're tapping in their home equity at a much cheaper rate now. That's
a good point too. So, and probably home equity lines over refinances, like cash out refinances, but that'll be interesting. It'll be interesting to watch that too.
Yep.
All right, let's move really quickly to our last topic. So Microsoft just hit the news today. They are buying energy from Constellation Energy. So Hao, I just want to turn it over to you. Why is this important? What's unique about this? And tell our listeners what Constellation Energy does.
Yeah, Constellation Energy is an energy producer, right? They own nuclear power plants. Specifically, I mean, a lot of our listeners might know this name is 3 Mile Island in Pennsylvania. They're lighting up that one of the reactors. Microsoft is entering a deal with Constellation Energy because they need to power their increased build-out. Whether we label it with AI, let's say generative AI goes nowhere, but the processing power needed for technology advancement, whether we call it AI or not, I think it's going to be needed. So as these companies build out, not just Microsoft, Google, Amazon, right? Anyone who has a big push for cloud computing, processing, is going to need lots of power. Do they tap into the current grid? Very likely not, right? Texas can't even handle a 10-degree drop in the weather right now, right? So that you have to, one, untap sources, which means lighting up old nuclear power plants. So I think Constellation jumped 15% today on the news because now they have a whole new market that they can address. Vistra Energy, who we announced or talked about several shows in Texas, also owns nuclear power plants that they can sell to the likes of Microsoft. I think this is pretty huge for utilities. Specifically energy generating utilities, not the conduit utilities.
What's it going to take for a tech company to buy one of these companies? Like, would the FTC approve that? It's it's not a competing. It's not like buying. Smartsheets in the news recently is they might get bought by private equity. Microsoft can't buy Smartsheet; that would get blocked, right? Yeah. So, I'm just curious. What do you think it would take?
I think Microsoft buying its own use, you can make an argument that it might be okay. I don't know. This is a very aggressive FTC in this administration. So it would take probably a turnover in administration. Lena Khan is very aggressive. She was going after CVS for putting in price increases for insulin. So she's really aggressive. I don't think a tech company could buy utility in this environment.
Now that I think about that too, I don't know if a tech company is using enough energy for an entire energy company. I don't know the answer to that. I don't know how much energy, say, Microsoft uses, and then how much energy Constellation generates. Yeah. But it just might not actually work yet. Like the energy company might produce 10 times as much as, say, Microsoft needs. And so it just doesn't math out.
Maybe it maths if you sell to Google, Amazon, if you're Microsoft, you know what I mean? Like here,
and wouldn't that be interesting? Yeah, Microsoft buys a company, sells it back.
The power.
Now powering, it's like we sell software and we sell power to all the data centers. Like, wouldn't that be interesting?
Yeah, I think it's a really interesting question. I don't think it happens, but you have to think. Someone in Microsoft probably said, why don't we just buy this company and we can create a whole power wing and control the power flow. Yeah.
And then somebody else said, nope, never going to happen. Not going to get approved. So then they struck this deal.
Yeah. Or they sourced this podcast for that.
Yeah, that's right. That's right. Okay. So what's just what is interesting here is that the 3 Mile Island nuclear plant is set to be turned back on. So maybe that tells us something that Constellation probably owns more than one, and they're turning on one to reach this deal. So they expect Unit 1 of the reactor. I don't know how many there are, but Unit 1.
I think three, yeah.
3? Is that what they call it? 3 Mile
remember the nuclear silos? They always come in threes for some reason. For some reason, it's stuck in my head.
Okay, all right, fair enough. So Unit 1 will be turned back on in 2028. Takes a long time to turn the key on these things, subject to approval by the Nuclear Regulatory Commission. And they also plan to extend the plant's operations until 2054. That is a long time, 30 years. So, cool. I think we might see more of this stuff as the power demands of these companies keeps going up.
Yeah, we have to. Yeah. Power generation, like now, isn't going to be enough to, keep this technology rolling.
I mean, PSE emails me to turn off my air conditioner when it's too hot out. It's like, hey,
it's 80 degrees. You only live in 75 or.
Well, no. I mean, when are you going to get the email that says like, stop using ChatGPT? Everybody, like, can you not use that from 6 p.m. to 10 p.m.? Yeah. Like we can't run your air conditioner and process an AI task at the same time.
And charge your electric cars.
And charge your cars at the same time. Yeah, just unplug some things. It's like you only get one of the three, like maybe that's the world we're entering to.
No, I think it's a realistic thing, though.
And people will sit in their hot houses running AI because, that's what's, you'll see these memes. It'll be people like sweating.
And he's like, generating some weird video.
Yeah. It's like have a LED light on with a small fan, battery powered fan, so you can run your AI models in a 90-degree house. That's good. That's good. Okay. Well, that's a wrap. Thanks everybody for tuning in to episode 58 of Top of Mind with Consilio Wealth. We enjoy all our listeners tuning in. Please send this to a friend. Our listenership is growing. We have a bunch more subscribers than we did only a month ago on YouTube. So if you're not following us on YouTube, please do. And we will catch you again in 2 weeks.
Thank you, everyone. Thanks, Chris.
Bye.